The market at new highs. What could happen to stocks when the jobs number is released? We're just points away from the Dow's record high. Joining us right now to talk about the markets is Andrew Slimmon. He is managing director and senior portfolio manager at Morgan Stanley Investment Management. Jason Trennert's here. He is our guest host today. He's the chairman at Strategas Research Partners. And Andrew, you said something in your notes that really caught me. You said 2019 was not complicated, nor do I believe 2020 will be.
No.
A lot of people thought 2019 was complicated. So what do you think is going to happen in 2020, and why is it
the reason
not
why 2019 wasn't complicated is it followed exactly the path of 2012 and 2016, which was we had big correction in 2018, just like we did in 15, just like we had in 2011, and people sold. We had big outflows the next year, and it takes about a year of outflows as the market rallies for people until people say, "Oh, wait a minute, I made a mistake. I shouldn't have sold.
You think
I should have bought."
was kind of chasing
So I wrote
here?
this piece in early December saying the capitulation is just starting, which is the capitulation is people have stopped selling out of equity mutual funds, ETFs, and they're starting to invest into risk assets, and I think we're in the first inning. Now, this is why you're seeing the market, the futures are indicated down, and then the market's up on the day. I think money is starting to come back into risk assets, and I think we're still in the early innings. Clearly, the market's very overbought short term, but I think that's why 2020 will be consistent with 2017, which was a swing back into equity risk. In 2013, which was the second year after the drawdown, people said, I got to get back in.
People think we're in the 10th inning. Right. I think we're in the first inning.
Well, no. Of big drawdowns. We had a 19%
cash goes into equities.
Exactly.
Right.
They came out last year.
30,000 almost.
We came out, but massive outflows.
He's more bullish than you.
No.
He's more bullish than I am, but I would argue, though, just if you look at inflows into ETFs and mutual funds over the last 10 years, since the market bottom on March 9th, 2009, there's actually been net outflows from domestic equities. The retail investor, the individual investor, has not been involved.
Do you know what
this at all? And that's not consistent.
But we've talked about the story for a decade, thinking that they are going to get involved. And the question is it possible they just never really do?
Maybe, but the share repurchase.
But what was the number one selling asset last year? The most purchased asset last year? The money market fund.
Yeah.
When risk off is the number one selling asset, that money is going, some of it's going to find its way back.
Didn't it take 30 years after the Great Depression?
It's not just the retail investor. Positioning amongst institutional investors was very, very bearish last year. And so that's adjusting also.
Didn't it take 30 years after the Great Depression until people got back into equities?
Well, until you made a new high.
Until you made a new high.
1929, you didn't surpass the 29 high until 1954. So you gave people two 50% declines at the start of this decade, right? 2000, 2002, 2007 to 2009. So there is a chance people don't, people are obviously gun shy. On the other hand...
Or there's a chance that we're setting ourselves up from the 1929 high.
I just don't see it. When you have interest rates this low, it again goes back to this, there is no alternative. And of course, that's creating other malinvestment, I think, in the system. But frankly, I don't think public equities is the place.
And if you could buy stocks, would you buy? If we could, would you finally buy now after listening to Andrew? Or if you could, because, remember the train that left the station? We got to Florida, and then we were down in South America, and then we went through the South Pole, and then we came up the other side, and now we're up.
The Trump bump?
Just the train that you were loath to.
The Trump train.
Just any train. The equity train. The equity train to get on.
I'm on the train. So
you finally got on. You didn't tell me.
I've been on the train.
You didn't tell me.
Joe, can I ask Jason and you guys, how much of this is linked to the Fed? I mean, the Fed started injecting new liquidity into the market. The Fed cut rates 3 times. How much of this is linked to the change in interest rate policy?
Absolutely. I think that's a big issue. But the point is that it takes about a year for people to adjust their view. The Fed changes policy because of something that happened out there.
Right.
They change policy, but people are still reacting to what already happened. And then ultimately it takes about a year. Just to be clear, I'm bullish on 2020, but I would love if Steve would come out and say, hey, the numbers aren't so strong, because my worry is economy is going to get hot this year.
Right.
We're going to get everyone back into the equity, much more positive about equities. and then the economy's going to get too hot, and the Fed's going to have to act after the election.
You said something really interesting. You are positive for 2020, but you also think the market's overbought here. What does that mean?
Short term.
Short term.
Clearly
so
overbought.
You could see a big...
all the technical indicators. I'm just not sure it's going to pull back, because the other thing that's consistent about these second years after people are selling is every pullback is an opportunity to invest, and therefore it limits the downside of those years. In 2013, the maximum drawdown was 5%. 2017, the maximum drawdown was 2%. I know everyone comes on these shows and say, well, there's going to be more volatility in the next year, because that's always a given. But I'm not so sure that's going to happen, because every pullback's a chance.
The economy gets hot. The Fed hikes after the election. Is there inflation or just a hot economy?
Hotter economy.
And
by the way, the yield curve inverted.
says they don't hike unless
the yield curve inverted right when it was supposed to. You realize that?
Where's inflation? Never coming back.
The yield curve inverted in August of 2019. The last 4 times the yield curve inverted 2 years before the market peaked. That would be 2021.
Let me just say that a hot economy is no reason for the Fed to tighten.
But they might change. They might, they might reduce liquidity, and I think that might be enough to stall the stock market.